Exactly. So let's wait a couple of seconds. All right, so it seems like we are all ready to start with this event. Hello, everyone. Good morning. My name is Juan Ramón Real. I work as a technical manager for the Research U project at the European University of the Seas. And it is my pleasure to welcome all of you to the second webinar of the Spin-off Competence Lab. With the Spin-off Competence Lab, our main goal is to incentivize and to promote entrepreneurship among our research communities, and more specifically among our young researchers, by providing you with the tools, with the knowledge necessary to turn your research ideas into business ideas, therefore by creating spin-off companies. In this second webinar, we will have with us Russell Smith from the University of Malta, that will be delivering a webinar, this webinar on the management of equity and funding for spin-offs. And without any further delay, let's give the floor to our speaker, who will both introduce himself and go into his presentation. So Russell, if you are ready, the floor is yours. Thank you very much for being here with us.
Thank you. Good morning, everybody, and welcome to this talk, which is really about finance for new business. We're talking about some specifics, and we've got, I was requested to break the talk down into bite-sized components so that it can be turned into a podcast or something like that. So I'm going to run through actually 7 presentations, 6 with information, and the 7th one is a summary, which can lead us into Q&A at the end. Happy to answer any questions. But the starting point for all of this is we do need, and it's always very difficult, of course, with an international audience, but we do need to be very clear about some words. The term spin-off or spin-out, depending on which country you come from, really relates to the creation of a company coming out of academic research at a university that may have some commercial potential. So that's the typical definition of what a spin-off or spin-out is. But it's nothing clever about that. It's simply saying that there are university people who have ideas and they want to turn that into a business opportunity. Now, most ideas around university research may involve further research and development of the technology, the ideas. And let me start off with the first key point everybody needs to know. No financier could care less about your technology. They're not interested. Now, this comes as mostly like a shock to many academic researchers who've spent their life in this area, and they're justifiably proud of what they've achieved and what they've done. So that sounds a very strange thing. Why are they not interested in the technology? Because real life financiers are interested in the ability of the management team to realize commercial value from the research that's been undertaken. The actual research itself is not a matter of interest to them. They may not understand it. So it really is all about the management team. And so please don't be offended if financiers express less interest in your technology. It's not because it's not interesting, it's not valid, it's not important, it's not life-changing or life-saving. It's none of those things. It's because what they're interested in is, if they put finance into you, can this management team turn that into a sound return to either repay a loan or to increase the share price for equity finance and so on. So we're talking this morning then about finance. If I can make this work. Yeah, here we are. So I would have to just, by way of introduction, I don't know what is actually showing on your screen. Is that now? Hopefully says speaker, so who I am. So my background is MD, PhD, so medical research in particular, and 3 spin-outs based on medical research from the University of Oxford. But more importantly, for people who are here today, I have, with colleagues, worked with over 8,000 new business founders from 36 countries. So what we're talking about now is real life and experience-based, and in particular evidence-based, and not textbook-based and theoretical or YouTube short video. It's kind of the real life experience over the last 25 years, I guess, and I hope you'll find that helpful. So in all of this then, the first thing that I would have to say to you is that any new business, doesn't matter what the business is, any new business will require some kind of startup funding. Every new business requires some startup funding. And what I would say is that it's very important to make a distinction between how accountants speak and describe things and how it works in real life in business. What do I mean by that? Well, I hope that you are looking at a slide that says describing business finance at the moment. Juan or Meg, can you nod if that's what's on your screen? Because thank you very much. So there are 3 main forms of financial reporting. The absolute important necessity for you to understand with a new business is the cash flow forecast. Now, we've created a booklet that I'm going to show you later, just 32 pages, that explains how to do this cash flow forecast, 1 page per year, simple Excel. And it's not difficult, and we'll go through that and you'll see how it works. But this is absolutely vital. It's a budget, if you like, it's your prediction, it's a forecast, and it's what you think your business is going to spend over the next year, because it's a page per year. Very simple. But it's also including at the same time, not just what you expect to spend, but what you expect to earn. And that's always more difficult to predict. It is a forecast. What accountants create and what banks request is a profit and loss account and a balance sheet. They're very helpful, but they refer to a trading period that's just completed. There's been no trading period if you're a new startup. So they don't make sense. That doesn't mean, however, that you don't have to do it. If you want to get the money from the bank, then you'll certainly have to provide what they ask for. But I cannot stress enough the real life necessity of a cash flow forecast. So we're going to have a look at that, and we're not going to look at profit and loss or P&L and balance sheet. So the cash flow forecast then is absolutely critical. This is in the booklet. There is a format for the spreadsheet, and we'll make all of these available. I won't be involved after today, but Juan Ramon will have a website, and I'm sure you'll be able to download things from that in terms of all this material, the booklet, and indeed even an Excel spreadsheet to help you. So what really matters then? Well, for a new startup business, and it doesn't have to be just a spin out, we need this cash flow forecast. If you've never done one before, take a look at the booklet that we've created. There's just a few pages there to read. If you're not sure how it works, don't try and guess. I'm not expecting you to become an accountant, but every new business needs an accountant. So ask your accountant to help you. So really important to realize that you need a team. You may be the best scientist in the world. You may have a wonderful breakthrough, but nobody expects you to be knowledgeable about business and certainly not about accounting. So please recognize you will need to put together a team to help you with this. So getting cash at the beginning is why we need to work with financiers. It's their cash, so we have to play by their rules. What are the key things to bear in mind? You've got to have cash to make progress. And the worst possible thing you should do is to make purchases. Never raise finance and then spend it on buying something. I mean, some people buy buildings. Absolute madness when you can rent them. It's all very standard. Rent wherever possible and buy almost nothing. You've got to use the cash to make progress. This is particularly true if you're selling shares, investment finance, as we'll look at in a later talk this morning. So it's the operational expenditure, OPEX for short, where the cash should be spent, and capital expenditure, buying machines, buildings, cars, is where you should never spend it unless you absolutely have no other choice. So use cash then to make progress, not to make purchases. So why do startups buy things? Well, traditional thinking, and it's not silly, it's pragmatic, is that if you buy something, if anything goes wrong with the business, you have an asset to sell, so you can pay off the debt. But whilst that's pragmatic, it's just nothing to do with entrepreneurship. And so I think that thinking is certainly outdated and probably flawed. I think it's sensible to wait until you become profitable before you start buying anything. If the business has got more money coming in than going out, great, then you're in a position to buy things. But don't use money that you've raised at the beginning to buy things. You've got to use it to make progress, hiring people, achieving milestones, etc., as we'll look at later. So it's all about a good management team. And what does a good management team do? It uses money to make money. And if we're looking at a good spin out from a good university with a good management team, I can give you a rule that you won't read in textbooks. A good team will turn every euro invested in them into €7 by the time of the next round. So you're looking at multiples of increase in value. If you were to buy a building in Malta, then maybe you'd get 8% per year as a return as the price goes up. So that's a multiple of 1.08. I'm talking about, in these spin-outs, a multiple of 7. And so it's a much bigger jump. But for the bigger jump, there is, of course, a bigger risk. And those things balance out. So is there a way of looking at this that's common to all business? Yes. And we call it the shape of finance, the picture that you're now looking at. The blue line is no more than your cash flow forecast, your budget, with your prediction of what money will be in the bank account at the end of each month over a period of time. And you can see at the beginning, it goes down. And so the red represents going negative at the bank. The green is positive. Now it goes down for a period of time, and then it comes back, it crosses the line. And then ultimately, you've got more money in the bank account rather than negative. There's only 2 pieces of information you need when you come to raise money at the beginning for a startup. Number 1, how long do you need it? And number 2, how much? If you need €1,000 and you expect to be profitable in 6 months, borrow it from mum and dad, if possible, or from friends, or sell your car. Don't take investment. If you need $1 million and you can't be profitable for 2 years, nobody will lend you money like that unless you can repay it. No bank. So you have almost no choice but to seek equity finance, which is where you sell shares to investors. So this shape of finance, how long and how much, determines exactly what you intend to do. For any startup business, equity finance selling shares is going to be a bridge too far. It's going to be too complicated and not within your reach. In the early stages, banks may be very reluctant to lend you money because you're not yet profitable or have no track record of being profitable. And so they would argue quite correctly, you can't repay the loan. So you must, any startup, begin by considering looking for grant funding typically from government, and most governments have those. Now, this shape assumes that there's going to be a break-even point at some time, and that's going to be true for the majority of businesses. It even applies to social enterprises. Although we're talking here about commercial enterprise, it applies to social enterprise. What is the difference between the two? In a commercial enterprise, any profit can be divided between the owners at the end of a trading period. In a social enterprise, profit cannot be divided between owners, and that's the only difference. You may have heard of a phrase or an acronym, but the phrase not for profit. Please never use that term. Not for profit is illegal. Illegal. If you are unable to pay your bills when they become due, whether you are a social enterprise or a commercial enterprise, you can go to prison. So not for profit is a very silly title. The correct term should be not for distribution. Every business, social or commercial, must be able to meet its liabilities, pay bills when they become due. So not for profit isn't real, doesn't exist. Social enterprises may get their money from donation. They may not be selling things directly to beneficiaries, but ultimately they must have more coming in than they're spending. So that's what we mean by making a profit. Often people in that sector struggle with the term profit, so we just use the word surplus, and then everybody's happy. But you have to have a surplus, otherwise it's illegal. Now, the shape of finance that I've showed you is common to pretty much anything. So what are the options at the beginning then to help address that initial shortfall? Quite often, the founder's own savings. Grant funding I've already recommended, sometimes a loan from family and friends. Crowdfunding, that can be useful, particularly when it's an upfront early payment in advance. Crowdfunding for equity finance is ridiculous for reasons I'll explain later, so please don't consider that. Debt finance, brilliant, but you're always going to be struggling as a new spin out or a new business to persuade a bank that you'll be able to repay the loan. So they may wish to take a charge over your home. So be very cautious about that. And equity finance, we'll talk about later, is about selling shares in the company. Now, ultimately, sales are important, but you may not have sales for some time. If you're opening a cake shop, if that's your business, or you're growing new types of vegetables for a specialist organic market, maybe you can begin to sell things when the crop comes in or when you bake the cakes. If you're doing something more long-term, and my area was development of new drugs, particularly for use in patients with cancer or very bad infections, it may be some years before the product is on the market. So no bank would ever lend the money. So it's really very difficult and your options are limited. But what this startup finance does is no more than take the blue line out of the negative. So raise what you need to cover the initial period when you're spending more than is coming in. You're going to have to find a way to do that. And it may be that you put some of your own money into it, etc., etc. So that's all you've got to really think about for startup finance. How much do I need and for how long? And that will then determine the way that you approach it. Now, I'm very happy if it helps people to take questions as we go along. Otherwise, we'll have them all at the end. I can't really see anybody apart from three faces, so I don't know if anybody has a question, but I'll let the organizer deal with that if that's needed. So I'll end that particular slideshow. Try to.
Very good. Thank you very much, Russell. If anyone has any questions to our speaker, please write them on the chat available for all of you on this video meeting room. Let's wait for 1 minute. Otherwise, I believe we should proceed with the next section.
Okay, well, as we're doing that, I'm just calling up the next presentation, which should be on your screen now, I hope.
Not yet. Not yet.
Okay. Okay, is that showing now?
Yes, now it's showing your screen.
Okay. Showing the wrong one. Hang on, just bear with me. Right, so the next one that we're going to move on to, which hopefully is now on screen. So this format you want me to use, I can't read things on my screen, but never mind, we'll get there. We're looking at the second presentation, which is about accessing grant funding and a little bit about crowdfunding. So is that the screen you're looking at?
Yes, yes, that's
Good.
the screen.
Okay, well then I'll go from there. That's great. So, we've put this information at the front of all of the things so that when you turn it into your podcast, it'll have it. But let's move straight into what we're talking about. So,
Russell, I'm very sorry for the interruption. Could you please use the full screen mode just for our viewers to have the presentation with a proper size? But if that causes you any trouble, there is no problem.
I don't know. We've asked me to switch it to something I can't seem to control this now, but there must be a way of doing it. Let me have a look.
All right.
So what are you seeing on your screen then? Because it's not working on mine at all since you changed it.
Exactly. Now it's the usual mode, not the full screen mode.
I have a colleague here. I'm just going to ask if they can perhaps recommend something.
Full screen.
It's not working. What are you seeing on your screen, please?
At this moment, the first slide with the title of this section, but in the normal mode, not in full screen mode. But if there is any problem with this, I believe we could proceed. It's not that bad.
No, I'm sorry, I have no idea. Since we changed the format, I can't seem to control it from here as normal. Apologies, we'll continue. Hopefully you can read what it says on the slide. So you should be looking at a slide that says grant funding. Yes, no?
Yes, yes, we can.
Okay. I'm still trying to see if we can get no. When you change something on my screen one, how do I change it back so I can do this properly?
Look, could you try in the lower side of the screen, at the right side, you have several options. The one a bit to the left, a bit to the right now, the one showing the screen, that's it. Could you click on that?
Yeah.
But for some reason it doesn't work. All right, there is no problem in any case. The size of the letters is all right, and there is no need to put the full screen mode if that goes in any
Okay,
problem.
we'll continue then.
Yes.
Good. So what you'll find is that almost every territory will have some kind of grant funding scheme aimed at helping startups, and many have follow-up schemes as well. And one of the great things about grant funding is that it is essentially a gift. You don't have to repay it, which is tremendous. Now, one of the things that you do need to be aware of is that the applications can be a little onerous. So always read very carefully the rules regarding any scheme. And it's usually the case that, as you might imagine, you can't apply twice for a grant from the same scheme. But there may also be other restrictions regarding funding you've had from government sources. So do read the small print very carefully, because whenever you have the opportunity for grant funding, you should certainly try to get it. So on the whole then, grants are not repayable, but you may have to meet certain milestones, for example, job creation targets or some particular deadline. And ordinarily, you may have to return some or all of the grant funding if you don't meet those milestones. So always under-promise in your application and over-deliver so that you don't miss out inadvertently on some kind of milestone. Now, one thing to watch out for is that many grants are paid retrospectively, which is to say you have to pay all the cash up front, and then you put in a claim to reclaim that funding. So it doesn't cover you having the money to pay for things. It reimburses you on money that you've spent. So you still have to have that money available from your business bank account before you do it. So be very, very careful about that. As I've said here, some founders use their own savings or access a loan from friends and family to cover a period, and then claim a reimbursement later. So be very careful about what the small print says. There are people who will help you with an application process. I don't recommend it as a thing to do in every situation, but sometimes it's valuable. Accountants are not particularly the right people to do this. They may understand about accounting, but not necessarily about your business and your plan and your milestones and what you intend to achieve. But some firms do specialize as bid writers, particularly for complex applications, for bids, particularly for European funding, where multiple partners across multiple countries become involved. And so working with those might be worth your while. But really, if this is your business, I firmly believe that you should write your own application. If you don't write the application and somebody writes it for you, if you're called in for questions, how can you defend it if you don't really understand exactly what's been written? So where possible, try to ensure that you do write your own grant application. I think winning grant funding is always a good thing. I think that if you win grant funding, other financiers and other parties will have increased confidence in your business because it's been approved by an independent party. that approval can also help persuade banks to make loans or investors to buy shares, equity finance. So it is always very good to win one, but make sure that you always comply with the rules and regulations so that you never have to repay anything later. Non-traditional funding then is something that's very popular on a range of things. You may have seen those game shows on television, things like Shark Tank or Dragon's Den, which don't represent real life, but they're very entertaining. Sometimes, unfortunately, at the expense of the people who are pitching, which is why they're not really to be supported. But it's not like that in real life. The non-traditional funding that is in real life is working with investors, in particular, wealthy or high net worth individuals who want to put some of their hard-earned cash into your business, and they buy shares in the company. It's called equity finance, and the cash then goes not to you, but into the company bank account. And they call business angels because they're there to help you. Why would they not want to help you? If they're giving you €1 and they're expecting you to turn that into €7, why would they not want to help you? So Dragon's Den, Shark Tank, it's all very amusing, of course, but not real life. So we're looking now here at a kind of halfway house, crowdfunding. And it's become very popular for young people to try to get crowdfunding to help them start a business. Some of that is fantastic. In particular, using crowdfunding to pre-order and pay for upfront one of your products or services can be great. Because if enough people buy your products and services up front, and they're prepared to wait until you've got all the cash in before you actually produce it, that's very supportive. Crowdfunding can also be used as a donation. If you're wanting to do something that people want to, help support you with. But using it to sell shares does not make sense. So don't entertain that prospect. If you were to have 1,000 people invest €10, then that sounds great. You can get 10,000 investment. But how are you going to be able to talk to 10,000 investors? The trick really is to have 10 investors, rather than 1,000 investors. So crowdfunding does not work. So where it is rewards based, that is to say, you put money into the company and you get something in addition to the product or the service, or whether it's just pre-ordering goods and services, it's brilliant. Crowdfunding for making a donation to charity is brilliant, but crowdfunding for selling shares is not appropriate. So don't go down that track. Now, when you look at choosing a crowdfunding website, very few are free. Many of them are really offering you a service, acting like a clearinghouse, and then expect to charge some kind of fee. And some people charge as much as 10%. So if you raise 100,000, they're going to take 10,000. If you raise 1 million, they're going to take 100,000. So you've got to be very, very careful about the percentage they take and whether they charge a fee as well. So some of them charge a fee and a percentage, a flat fee, but then a percentage of what you make. You also want to know who are the people putting money into this? Are they experienced? Are they appropriate? This is not something where you want to be taking money from vulnerable people. So be very careful and cautious and look at the background to whichever crowdfunding website that you use and make sure that they have appropriate steps in place to protect how they do things. Now, in terms of pros and cons, then I think donation-based is a good opportunity, depending on what fee percentage the website takes. Reward-based is now not so much for the website, but for the person putting the money in. So they will get, let's say that you want to publish a book. And let's say the book is about the country that you're in, and there's a lot of people who might want to buy it, but you can't actually print the book until you have the cash coming in. And what you say to them is, we will send you the book once it's printed. So you're buying the book, you're also paying for shipping, but the book will also be signed by the author. And so that's like a reward. And it'll be signed to you personally, or you can make it as a gift, or we'll have a signed photograph of the author, whatever it happens to be. But something, if it's seen as a reward, people are happy to do. Equity finance is very, very different. And this is where crowdfunding is entirely appropriate. We'll talk about how to do equity finance a little bit later. There's something called peer-to-peer lending, and this is a new form of funding whereby people use a website and they're looking to lend money under special terms. So if you're looking to raise 80,000 from a bank, a new business may struggle very much to raise that because they can't repay it quickly. But peer-to-peer lending websites sometimes will put together 80 people who are prepared to lend you 1,000. Now, why won't the bank do it? Because you are high risk. So why will these people do it? Because you are high risk, and therefore they'll expect you to pay a high interest rate. So you have to decide whether these things are worthwhile for you. On the whole, not very often. When you choose one of those websites, be very clear as to how decisions are made and what security, if any, you have to put up. If you're having to pay a very high interest rate and they still want to charge over your house or some other kind of asset, I'd recommend you think again. So make sure you're very clear about all of this. And on the whole, this is not the top of the list of where you should be finding startup funding from. So a cautionary note then. Crowdfunding and peer-to-peer opportunities are not yet considered mainstream. And some people are nervous about the regulation of them, which is me being English and polite. They're not regulated properly. So please be cautious. If you are in any doubt, do not do it. Remember the old phrase, fools rush in where angels fear to tread. So be very cautious and talk to your accountant, talk to a professional advisor if you're not sure. Perhaps I'm being a little harsh here, but I don't think you should rush into something without good professional advice. In conclusion then, grant funding is fantastic. And genuinely mean that. Governments that seek to help new, young startups by giving a grant, typically up to, well, in Malta, for example, up to 25,000 euros, that's terrific. That may not be all that you need, but it's a fantastic start. And providing you meet the rules of their scheme and you do what you say you're going to do, you can't spend that on buying yourself a Ferrari or going to the Caribbean for a holiday. But providing you do with the money what you said you were going to do, and providing you follow the other rules of the scheme, you don't have to repay it. It is fantastic. And it's one of the few ways in which young people can actually find funding for a new business. And therefore, it's really terrific. But before you seek any form of finance, do seek expert advice. If you are anywhere near an incubator facility, then go and talk to the people in the incubator who advise new businesses. They're often attached to a government function or more commonly a university. There's certainly one here in Malta. Our own Takeoff incubator is part of the University of Malta. So talk to the experts in there who will know about the local schemes, certainly for grant funding, etc., and take their advice. It's very, very important. So that brings us to the end of this presentation. Again, if you have any questions, then by all means put them into the chat room or whatever it's called. I will try now to bring up the next one.
Thank you very much, Russell. Since it seems that there are no questions on the chat, I believe we can proceed with the next section of your presentation.
Good. So just with an eye on the time and what I think is going to be most helpful to cover, because at the end, I do want to right, I'm trying to find the share screen. I'm sorry, since you changed the screen, I can't find anything, but let's see where we are. Are you looking at SEAEU4, equity finance? Can you see that? No?
No.
Okay. So what are you looking at now? Anything?
At this moment, yes, investors equity. I cannot see the full message because of the, but yeah, I have the confirmation on the chat that we can watch the proper slides. Could you turn on the second slide so that we can see the title? All right. That's it. Equity finance. Yes.
So it's big enough for people to see. I need to change it back to how I had it, but never mind. If you can see it, then we'll continue. Apologies, everybody. Okay, so what do we mean then by equity finance? Let me explain exactly what equity finance is. Extremely difficult. Extremely difficult. So do not be fooled into thinking that a 5-minute YouTube video can explain how to do it. Do not be fooled into thinking that somebody with a Californian accent talking about what happened in Silicon Valley is how it happens in real life. It is not. Firstly, Silicon Valley is very special. It's a unique situation. And secondly, equity finance is extremely difficult in any country. What it really involves is you raising cash for a business by selling shares. Now that means immediately you can only do this with a private limited company, because only a private limited company can issue new shares. If those shares are then bought by a third party, let's say they buy 25% of the shares, then the new party owns 25% of the company. And the money that's paid goes into the bank account of the company, not into the original owners or founders. So why do people buy shares? For 2 reasons. Firstly, if it's a new company, they want to buy the shares at a low price and then sell them in a few years' time for a higher price. And that's called the exit strategy, the exit. So the entry point is buying the shares, the exit is when they sell those shares. So that happens possibly up to 5 years later. Sometimes people buy shares in pre-existing successful companies traded on a public stock exchange, and those are called public companies. And that's very different from what we're talking about here. People buy shares in those companies and they would expect to have a percentage of profits proportional to the percentage of shares that they owe every year. For a new company, we don't issue profits as a share to owners. We're using that money to grow the company, to build it up rapidly, and then ultimately to sell it. Because the money that we're making, if we're making profit, is much better used by building the company so we sell it for a lot more later and make a higher capital gain. Everything here goes back to the shape of finance that I've shown you. raising equity finance is very important and vital when you need a lot of money, and for quite a long period of time, you won't be able to repay a loan. So bank finance is impossible, and equity finance is your only way to go. And sometimes it has to be raised in multiple rounds. So nobody would ever raise all the money they need at the beginning. You raise a certain amount of money at the beginning when your share price is low. You have to make progress. So your share price goes up, then you issue new shares, raise more money, and so on. So you do it step by step. Why do they buy shares? Quite simply, to make a capital gain. The investor wants to buy shares now and sell them at a later date for a higher share price. In order to do that, you've got to persuade them of two things: that the company has the potential to grow very rapidly, and secondly, that you as a management team have the ability to facilitate that growth. Are investors interested in the technology? No, couldn't care less. They're looking at your potential as a business, and they're looking at your ability as a management team to take the business forward and make the company worth, maybe 10 times more than it is today in a few years' time. So perception is all that we have to be thinking about here. And to actually make sure that you meet their expectations, you've got to match that perception with progress. So this is why we need to make progress as we go along. So potential, perception, progress, all very important. Does it have anything to do with your end of year accounting figures? Absolutely nothing. If you're not generating revenue, every year your accountant will say quite correctly that in accounting terms you've made a loss. But your share price might be going up in the eyes of investors because perhaps you have developed a new strain of organic vegetable that you can grow and dominate a European market. Fantastic. Or you filed a patent for a drug that looks promising in the clinic in some type of cancer. Fantastic. Have you made any money? No. Have you spent a lot of money, more than is coming in? Yes. What do accountants call that? A loss. What do investors call that? Great progress. Well done. So please, you need to be thinking about things differently. Everything that's important relates to progress and the perception of that progress. So very, very important that you persuade investors about the progress you're making. What do they look at? Well, if you're a trading business, then of course, the profit and loss and balance sheet are important, but we're not talking about trading businesses. We're talking about new business. Somebody wants to start up a new entity, particularly spin-outs, or they're not very often called spin-offs, but spin-out companies, new companies from a university setting. But all businesses are the same. They only sell one thing. Only sell one thing. Every business only sells one thing. It's called know-how. And that know-how is packaged in one of two ways. Only a product or a service. There's nothing else. So all businesses sell know-how, and they package that in one of two ways, or sometimes both. A restaurant sells a product and a service, for example. So a university spin-out based upon the most incredible research that's been undertaken over a 10-year period by world experts is still only selling know-how. Somebody who's been working in the fields, doing real work, toiling with their hands, growing a strain of vegetable which is resistant to a particular type of disease. The know-how is how they've done that, how they've achieved that. It's still know-how. and they're still selling a product or a service. So this idea of know-how, product and service, you've got to be very clear about what it is, because you've got to protect that know-how, and you're not looking at what accountants think, you're looking at what real people think. So what real progress have I made? What steps forward have we taken? Is the company now worth more? Have we made enough progress to say we're in a better position now than we were before we spent the money? So these are the things you've got to be thinking about all the time, and that's what investors look for. So what is the most important? The management team. Again, my sincere apologies to those of you who are, learned research scientists. I know you believe in your research work. I know how important it is to you, but I'm explaining how important it is to financiers. And the answer is they couldn't care less. They will be polite and they'll say it's very exciting and very interesting and marvelous. But what they're really interested in, can this management team fulfill the opportunity created by the technology, by the research? And so they're looking at the business. And if they're buying shares, they're buying into the business. They're not buying into the technology, they're buying into the business. So don't be offended by the attitude of financiers. You've got to make it very easy for them to understand what the technology is all about and what it does. But it's the business that they're interested in buying into, not the technology. If it was the technology, you'd be applying for a research grant. But you're not. You're applying for business funding, and that's not the same thing as a research grant. When you sell shares in a company, the most common way of doing that is selling ordinary shares, and those all have the same weighting. So anybody who has one ordinary share has the same, authority, decision-making ability as somebody else with one ordinary share. There can be different share classes which have greater authority. At the beginning, try to avoid that. They're often insisted upon by what's called venture capital companies. Those are large organizations that will be investing 5 million, 20 million. I suspect few people listening to this talk are looking to find 5 to 20 million. So let's not worry too much about that, but be aware that those large organizations are very difficult to deal with. And they have so many people applying for funding from them, they're able to turn down well over 95% of applications, and probably only 2% get the money. So unless you agree to their terms, it's very unlikely you'll get their money. So let's not worry about those, but focus more in terms of equity finance on working with individuals, the business angels. Now, we've seen quite a lot happen in Malta, which is entirely inappropriate. We've seen it in a number of settings, but quite often in an area where it's not a mature discipline. So in regions where equity finance is not a particularly mature way forward, wealthy people will say, okay, I will put in 100,000 into your company. That's my investment. And I will take 50% of your company. And you will repay me that money at 9% interest per year over 3 years. That's neither a loan, nor is it equity finance. It's called stealing. And such people should not be allowed to get away with that. Let's move to the reality of what should happen. Whenever you sell shares in your company, you set the price of those shares and people either pay that amount or not. Just when you go and buy a pizza from the takeaway shop and you say, how much is the margarita pizza? And they say €6.80, you either pay it or you don't. It's not a discussion or a negotiation. So there are some different ways of thinking about this, but you're going to buy the entire pizza, but this is about buying a slice of the pizza. And so that being the case, there will be more than one person owning a portion of the company. And so if one group has more than 50%, they're referred to as the simple majority, and they're allowed to make all the decisions because they've got more than 50% ownership, unless there is an agreement between the shareholders that protects those who have less shareholding. And so a shareholder agreement is very important, and you should talk to a corporate lawyer about this. And they cover such things as ownership, voting rights, control and management. And they protect the company from competing interests. So if 10 of us owned a company, I can't go and sell my shares to a competitor because that would not be in the best interest of the other members of the company. So if you're thinking of raising equity finance, you must have a shareholder agreement. I do not want to explain exactly what it contains because I do not want to turn you into a lawyer. What I want to tell you is you must have a lawyer do this. This is not DIY. This is not a 5-minute YouTube. This is something where an expert with experience has to do it for you. So one of the good things about this is this section on dispute resolution. You can include rules about what will happen if something, arises. How do we get to a decision? And one of the things that does happen is that somebody comes along making an offer for the shares of the company to buy the company, and quite a lot of people say, I'm prepared to sell, quite a lot of the owners, and 1 or 2 of the owners say, I'm not prepared to sell. And so we have 2 common things in this agreement, which are referred to as tag along or drag along. All it means is if enough of the owners are in agreement, we can make everybody else sell because we drag them along to that. Or as if somebody else gets a good offer on the share price, then the rest of us can tag along. All of these things you don't need to worry about. Be aware that you mustn't make decisions unless a suitable number of people agree. Otherwise, it's just who has more than 50% owns the company and runs the company. So do investigate shareholder agreements if you intend to raise equity finance. I'm sure equity finance will be new to many people. So very happy to answer questions on this if you have any, either at the end or now or whenever is convenient. So let me stop at that moment. If I then go to the next one. Right, so you should be looking at something called valuing a business, and I hope you can see it, or at least adequately.
Exactly.
Now, the reason that this is important is that how do you value a business when you sell shares? Well, first of all, let us say that we have, and I'll show you some numbers and breakdowns so you'll see how it works shortly. But first of all, let us say that you need to look at the amount of money you need to raise in order to cover that shortfall. Do you remember that shape of finance picture that governs everything? How much money do you need? Well, you've got to be able to raise enough to cover that. So that's the amount of money that you need. And if you were to, let us say, for example, I need to raise 100,000 euros, and I'm going to issue, shares at €1 each, and I'm going to value the business at 500,000 euros, then I'd only need to issue 20% to get the 100,000. So it's a kind of juggling act between how many new shares to issue, how much you're going to charge for them. And so the valuation is less to do with the value of the company and more to do with the money that you need to raise. So the 2 things are going to go hand in hand. So is this something that can be done by an accountant? I have to say, I've been doing this for many decades, and I've never met an accountant who we used or who understood it. It is all about perception. It's all about the performance in the market, what's happening out there. So you need to be reading the business pages of newspapers to understand what's going on, local sentiment, flavor of the month. Sometimes, many years ago, bioscience was the big thing when the human genome was decoded. Then we went on to a range of other things. So blockchain, people thought that word meant something and decided to invest money in it, whatever they were doing. So you'll be surprised at how much sentiment can have a big impact upon valuation. And what is the flavor of the month? Currently, it's the metaverse, things like that. Though, of course, you'll have seen it's actually broken the back of Facebook in terms of the emphasis that Zuckerberg has put into it. But these things go up and down. So there is sentiment. Sentiment is part of the valuation. The next bit to be very clear about is, what have you got? Do you own it? What have you got? And then what can you do with it? And what evidence that you've collected that people will want to buy it? So it's a combination of all of these things that must be there, coupled with a good management team that will allow you to put forward a good valuation. So this key thing is where you need experienced advice. It's nothing to do with an accountant. Accountants will value a company using trading figures, but if you haven't yet started trading and you haven't bought anything, then you can't be worth anything. So it's not just an accounting thing. So the basis of equity finance is that investors buy shares at one value and then sell them later and make this capital gain. So it's critical to establish a valuation for the company ahead of raising equity finance, where the initial valuation, what's called the pre-money value, allows you to sell shares and raise the money that you need to cover that period that you saw in the shape of finance figure. Is this an art or a science? I think it's much more of an art than a science, to be truthful. Some people are good at this, some people less so. There are a number of things you can learn in business schools. Most of them are hopeless. Net present valuations don't really work. It's much more about looking at what's happening within the local investment community, what's happening within that particular sector, what seems reasonable. And so, without that experience, a new business founder should never, ever try it on their own, because they're not going to get very far. And you only get one chance to make a first impression with this type of investor. So what are these, just to summarize then, and to use alliteration, there are 3 S words that are worth bearing in mind, that factors that affect valuation. First of all, supply. Are there lots of businesses wishing to sell shares in the same space? Because investors will compare which one they would like to go with. It's nothing to do with the technology. It's about which has got the best management team. They'll be interested in the sector. Some are more interesting than others. And then there'll be sentiment. At the moment, there is nervousness. Funding and finance is not easy. Prices are going up. We have a lot of problems to tackle, not least of which is climate change, and not least of which is we have a war in Europe. So these things are very, very important and part of the sentiment. So there are general conditions that means it will be easier or harder to raise equity finance at any one moment in time. For a new business, valuation cannot be based upon profitability, because you're not selling anything. So you have to forget that. A new business valuation must be based upon the theoretical probability of the business at some point in the future, and estimated from the cash flow forecast, doing well. And then investors will say, but we'll have to discount that because there's risk and, there'll be a cost for entry. So what you may be worth at some point in the future, theoretically, can be discounted backwards to say, so what are you worth now? And that's called a net present value, NPV. Business schools will teach you complicated equations. Most of them are a waste of time. They're interesting, they're useful, and they can give a guide, but most people are going to go on sentiment with respect to what they think of as the quality of the management team. Who can help you in doing this if you've never done it before? Well, for a new business founder, setting a valuation for a company, and hence a share price, is very daunting, and knowing where to start is hard. So don't. Bring in somebody who knows how to do it and get their advice. Some accountants may have done that, not many, not many. Try and find somebody who's done it in real life and encourage them to be part of your team, possibly paying them to come in for half a day a week. That may be gold dust. Remember that working 9 to 5 or 8 till 5 or whatever, 5 or 6 days a week is only a convenience factor. Having somebody that you really need just for a short amount of time can be fantastic. And so bring in experienced people to help you, particularly at this stage. So not somebody who talks about it, but somebody who's done it and somebody who's got experience. And ideally, those people may also know investors who may be willing to invest in your business. So let's look at a simple table to give you an idea of how this works. So we're looking now at this startup case study that we've called XYZ Limited. And what we're looking at is round one, because remember, equity finance is done in multiple rounds. In round one, we're saying that the company has 1 million shares and they're all owned by the founders. And so the founders, which has got the blue background in the cell, own 100%. There are other classes at this stage that we might bring in. They could be friends and family. How many shares are owned by friends and family? 0, none. Business angels, venture capital trusts. These are the high net worth individuals. How many of those have bought shares? None. And the later stage venture capital companies, how many of those have bought shares? None. So where does this value 60,000 come from? I made it up. This is real. This is a true story. The founders said the 4 people could all afford to put in 15,000 each, and 4 times 15 is 60,000, and that money goes into the company. And so if you divide 60,000 by 1 million shares, you end up with a share price of 0.06 euros. So we've valued the company purely on the basis of the money in the bank because we have nothing else. So it's not complicated. At the next round, however, it's going to be slightly different. Let's say we use these 60,000 as we did in real life to make progress. We then decide we need more money to continue forwards. And let's talk to friends and family who may be prepared to do that. And we said that now we're going to issue new shares and set a price of 0.46 euros and issue 200,000 new shares. And that would raise 92,000 euros. So we've raised the share price because we believe we've made progress. And so we're now more valuable than when we started. We spent the 60,000 and we've made progress. But where did the number 0.46 euros come from? We made it up. We decided what it was worth. And then other people have got to decide whether they agree to buy at that price or not. And so by issuing new shares, 200,000 new shares, there will be now 1.2 million shares in circulation. And the founders no longer have 100%. They've now got 83.33%, as you can see on this table, because new shares have been issued. So the founders now have 83%. So they own less of the company than they did own. Yes. Isn't that a bad thing? No, because originally they had 1 million shares worth 60,000. Now they've got 1 million shares, but the share price has jumped up from 0.06 to 0.46. So the number of shares has remained the same. The percentage of ownership's gone down, but the value has gone up. And that's the key. So we can do this again. And we can say, we'll go now talk to business angels. Let's spend that money that we raised. And then let's raise 400,000 at the next round. And so we go through this process, and here's the next table to look at. And so what we're going to do is issue 500,000 new shares. So the total number of shares in circulation now is 1.7 million after the round. But there was 1.2 million. And if we're selling if we have 1.2 million and we're selling shares for 0.90, then the company prior to raising money was worth 1.08 million. And if we issue 500,000 new shares and they're sold at 90 cents, then we'll bring in 450,000. So the company is now afterwards worth the pre-money valuation plus the money that we've raised. And we continue doing this going forward. Is this easy? No, extremely difficult. Please do not listen to people who say that it's easy. I would say to you, in my experience over 25 years, raising money can be easy. Raising money at the right share price is very difficult. So you've got to ensure that if you've never done this before, you don't just need somebody with little experience, you need a black belt in your team, somebody who's got a lot of experience to help you and to guide you through the process. With that good team in place, great. Without the good team in place, you will either never do it or you'll make terrible mistakes along the way. And I don't want you to have either of those problems. So profit, progress, and perception. So please note that this method of valuation takes no account of sales revenue since the business is not yet trading. We're not selling anything. We're using the money to fund our R&D. And investors are buying shares in the company in the belief that the business opportunity is good, but most importantly, the founders, the management team, are capable of delivering the business plan. So progress is all important for the increasing value of the company and hence the rising share price. So in this situation, the founders did have help, in this case study from an experienced entrepreneur who was able to guide them. So if I was to conclude this then, what would I say to you? Never do equity finance. But let me soften that a little. Equity finance is very difficult. Never do it unless you've got an experienced person to navigate the way for you. So even people who operate cruise liners, captains with decades of experience, still get a pilot to guide them into port. You need the pilot. Don't think you can do it. It's very difficult without help. Common mistakes can arise over valuation, and you either raise too little or more money than you need. And please avoid self-proclaimed mentors and absolutely avoid accelerators. They're often no more than financial schemes looking to buy into a company at a low price. You've got to have objective advice from people who've done it before. You can perhaps get that from a good accountant, and there are many, and I know many like that. Or you can get it from people who've done this in multiple ways. So you're looking really to help you progress through this to find an experienced entrepreneur. And for me, I mean, as you all know, it's a French word, which could be translated as in-between taker. It's not what most people think. But an entrepreneur, for me, is somebody who is good at business, not just simply successful in one sector. You know, you could be a great restaurateur because you're a great chef. It doesn't necessarily mean you're going to be, you know, great running any type of company. Entrepreneurs can run anything. So it's about the business expertise. And make sure that you get a really good accountant. You want to have the best possible professional advisors that you can find. Let me pose you a question. If you fell seriously ill and you had to pay for medical services, would you say, you know what, I'm going to find the cheapest doctor I can find. I don't really care if they're any good, just as long as I save money. Or would you say, I'm going to find the best doctor I can for what I can afford, because actually surviving is important to me? Well, I think you'd do the latter. So don't go for the cheapest, go for the best you can afford. Okay, so that's the end of that presentation. We have reasonable time, it's 11:52, and we're going to now move on to the final presentation. Right, so you should be looking at, I believe, making progress against milestones. Can you see that?
Yes, yes, we can.
Okay, and again, apologies for the format, but never mind. So let's just go through this quickly. So what do we mean about making progress against milestones then? Well, whichever kind of finance that you bring in, you're going to have to meet progress against milestones identified in a business plan and your cash flow forecast. So if you go to a bank, they'll want to see a business plan, they'll want to see your cash flow forecast. They may want to look at a hypothetical, theoretical profit and loss and balance sheet, which of course can be derived from the cash flow forecast. So only put milestones in that you feel confident about being able to achieve. So what we're looking at here is events that add value to the business, and they should always be linked to a timeline and to a budget. So we'll do it by this period of time, and we'll do it within this amount of cash, the budget. And for equity finance, that's absolutely critical. And certain things will add value to the company overall. Let us say we hire a really good commercial director who's made millions and millions from her previous activities. If we can encourage her to join the company, the value of the company has gone up simply by hiring somebody who's fantastically good at the job. We can launch a sales campaign in a different country. We can do any number of things like this. We can file a patent. Are we selling anything here? No, not yet. So it's about adding value, because the more we add value, the easier it will be to realize the potential of the company. And every time we add value, we're demonstrating the ability of the management team to do that. So profit and loss is important, but remember, it's not just about sales. It's things like recruiting senior staff, like the woman I just mentioned, successful results from research and development, or even filing a patent. And accountants will always say, oh, you've got to minimize expenditure because you're making a loss. No, investment in R&D is not viewed as a loss by investors. It is by accountants, but not by investors. And so you need to just look at this in a slightly different way. So in equity finance terms then, milestones can be thought of as key performance indicators. And regarding one thing, the management team, have they done what they said they were going to do? And the third bullet point here relates to if the company can make progress against the plan, then shares will be viewed by investors as more valuable right now than when they were bought. And that's exactly what they're looking for, because at some point in time, they're going to sell them. And you need to set out in your business plan and in your cash flow forecast clear milestones about what you intend to achieve. I think it's sensible to be, quite limited in what you include. I think grouping milestones into quarters in a 3-month period is sensible. So over 3 years, a typical length of a business plan, that would give 12 quarters. And if there were 5 key milestones identified per quarter, then there'd obviously be 60 milestones to achieve over 3 years. Guys, that's more than enough. 60 is more than enough. Don't get too carried away. So if we're saying that 5 things to achieve every quarter, and there's 12 quarters, then 60 things, that's enough. And from that, if you were to achieve a substantial proportion of those, then you will have made progress. But not everything will go to plan. So I'm saying here, look, maybe you get 50 out of 60 milestones. So 10 out of 60 didn't happen. You weren't able to do it. Is that a disaster? Not necessarily. 50 out of 60 is still pretty good. So that's why having a large number of milestones like 60 allows you a little bit of leeway. Not everything worked. Yeah, it's real life. We're all human. But we've delivered 50 out of 60 things, so we can do it. And that's very important. But can those milestones change? Yes. Everybody, well, not everybody, but quite often one hears people say, I didn't have time to write a business plan. I've been too busy doing work. Well, that's the most ridiculous statement you can possibly think of. If you don't have a plan, how do you know what you're supposed to be doing, and how do you know when you've done it? Another phrase is, I make it up as I go along. I don't recommend that either. So milestones in a plan can change. Progress in a plan is typically reviewed at a company board meeting every month. Sometimes the board decides to change the milestone, perhaps to put more resource into it, to increase the budget, or to reduce it. Sometimes it might be terminated. But please also remember, new opportunities come along that may create new objectives that become incorporated into new milestones. So a business plan is not something you write for the bank manager because she asked for it. It's a living management tool, and expect it to change a little bit every month, and perhaps, a bit more every quarter, and maybe every year it changes quite a bit, but it's a living document. So you have to report on progress as you go along to all the owners of the company. And that means the original founders and anybody else who's later bought shares. And so it's typical to give a progress report, a comprehensive one, once a year at the annual general meeting, but you may send out a quarterly report. So in conclusion, getting your milestones right is an important aspect of business planning. For companies funded by equity finance, the management team has got to be very clear on reporting progress regularly to shareholders. There are legal requirements to do that as well. And progress against milestones is a key indicator of company value. So if things are not going according to plan, then the management team must recommend a new plan for shareholders, the owners, to approve. Now, this has been a quick run through of some of the aspects of finance that you need to take into account. To help you with this, we've also created this 32-page booklet, which I'll just quickly show you, if I can find it. So let me see if I can do share screen again. And here it is. So you should have on your screen, it will be impossible to read, of course, so don't worry, but it's basically, if you were to print it out, it's a 32-page booklet. And the sections within that relate to some key aspects, some key concepts of enterprise and entrepreneurship. Starting off with the business model, the various business structures, what is a value proposition, your intellectual property, market research, which is very different from marketing itself, and then the business plan and the cash flow forecast. Routes to market, how you get there, channel partners, people that may be helping you to get products onto the market, defining your team, business finance. And for those of you who are doing this on a personal basis, very important to think about your personal budget. Today, I've stressed the importance of the business plan, section 7, and the cash flow forecast, section 8, because if you intend to raise business finance, you will need both. So I'm going to go down to those sections. So to number 7, first of all. And as you can see, and I hope that you can more or less read this, it's not easy because the format's been thrown out, but so we're saying that business plans are quite short, maybe 25 pages, not like a telephone directory or a PhD thesis. And they have one page at the front, the executive summary, about 400 words, which is the most important page. You've got to introduce your technology, the background, whatever it is, section 2. Section 3 is about the business opportunity. Section 4 is about the management team. And then 5 is the operating plan, which is no more than how are you going to get there. Everything else goes into the appendices. So bluntly, the executive summary is probably the most important page. If you don't do that very well, or if you run over one page, financiers will probably read no more and just throw your plan into the bin. So it's critical to get this right. So you do need to work on that. The other sections, because we're looking at this as a spread, so we're going from there to the introduction about the background. So this explains the things that you need to write about in the various sections and all that you need to include. Now, the cash flow forecast has a general layout, and I appreciate you can't see it on screen at the moment. It doesn't matter because we'll have this as a download for you, but it's also 90 degrees out. But these are the rows, and there's money coming in and money going out. And at the end of the month, with so much coming in and so much going out, there's a balance in your bank account, the company bank account. And that's what you plot to give that shape of finance picture. Very, very easy. How much do I need and for how long do I need it? And so we go through in this booklet, row by row, everything that you need to include. Now, is this a standard that everybody uses? No. Why should you use it? Because of the 8,000 people we've helped, they have between them raised over 100 million in both equity finance and debt finance, 100 million. And that's in 36 countries. So we can recommend this to you as something that we know works. So we've captured this in just very limited number of pages, as you can see here, but row by row. And if we come now to look at the cash flow forecast itself, please note it is 1 page per year. So this first column describes the rows, and then the rest of the columns are months of the year, and then the total at the end. It is not difficult to achieve. By all means, use other spreadsheets to calculate sales of products, services, whatever you want to do, and then summarize in this 1 page one. But good financiers will look at the executive summary, page, single page. They'll look at the cash flow forecast, page, single page per year, and they've probably come to a decision just from those 2 pages before they read the rest of the plan. If you are working alone, please let me recommend to you giving consideration to your personal budget. The amount of money that you need coming into a new business must match what your outgoings are on a personal basis. And remember, your salary will be deducted from tax, it's a tax deducted from it, etc., etc. So this very simple way of creating a personal budget could help those of you who haven't done this before. And let's it's a private document for you. You don't show this to anybody. So yeah, I do want to know how much you spend on smoking. I don't want to know. I want you to be honest with yourself how much money it costs to buy cigarettes every month. You don't have to tell anybody, but be clear about the money you've got going out. Be brutally honest with yourself. You don't have to show this document to anybody, but be brutally honest with yourself, because at the bottom here, so how much money do I need every month and every year? And if your business cash flow forecast cannot support this requirement, don't start the business. Do something different, or do it differently and better. Now, I've tried to leave some time to allow an opportunity for any questions that people may have. So I am going to do stop share at that point. And so hopefully now, those people who have not fallen asleep or committed suicide through boredom, who are still here, if you have any questions, I see there is some people in the chat. I'm going to answer the questions, and Juan, why don't you facilitate that as we go through?
Thank you very much, Russell. It has been indeed a very, very important and exciting presentation, I must say. No boredom at all. It has been really fruitful, I believe, this event. By the way, for those of you who might not know it, this booklet Russell has just shown to all of you will be made available on the project's website for all of you to have a look at it. And well, regarding possible questions, I cannot see at this moment any questions apart from some participants' comments at some point, but no specific questions as far as I can see. So
I'm happy to take questions now if anybody wants to shout up. And guys, trust me, raising finance for business is difficult. And so if you've not done it before, ask any question. There's no such thing as a silly question. So just please ask anything, and let's see if we can help you for the next 10 minutes or so. Okay, well, if there are no questions, not to worry. As has just been said, the booklet's available for you to read through. We're going to provide you also with the Excel spreadsheet. It's a single-page spreadsheet for you to easily complete the cash flow forecast. If you are looking to raise business finance, I must say to you, please take advice. Always apply for grant funding if it's available. Be very careful when applying for debt finance, that's a loan from a bank, about the terms and about any security that you give. And never try to raise equity finance selling shares unless you have somebody in your team who's done it before, because you're going to get your fingers burnt, sadly. Okay, well, I hope that's helpful to people, and enjoy the rest of the day. And I'll say thanks for the attention of those who stuck it through to the end. Okay, thank you and goodbye.
Thank you very much, Russell. And with this ends our second webinar of the spin-off Competence Lab. Thank you very much to all participants for your attendance. Certificate attendance will be issued as soon as possible. Maybe in a few weeks you will be receiving them. And that's it. Just for you to, just as a reminder, next Friday, the 11th of November, we will have our next spin-off Competence Lab webinar. You can have, you already have all the information about this on our project's website. That's it. Thank you very much and see you very soon.